To invest successfully, you have to ask the right questions, both of yourself and of your investments. No publication can hope to answer questions about you as an individual, but Morningstar can give you information about individual mutual funds. Many investors identify their goals successfully, but then choose the wrong funds to meet those goals. You may know that you have a long-term time horizon and that you're moderately risk tolerant, but then invest in a fund that's more appropriate for a short horizon or one that has more risk than you're willing to take. What we hope to bring to the table is a more complete picture, one that gives a good descriptive grounding of what it is you're investing in, to make sure that you know what you're investing in and that you invest in the right funds for the right reasons. We use three primary criteria in selecting mutual funds for coverage. First, we rank all funds we are not currently covering by their assets, an indication of potential interest, and give preference to larger funds. Second, we monitor requests made to our product support staff. If we have many requests for a particular fund, we may choose it over a larger one. Finally, we look for funds that follow unique strategies. We'd rather cover a semi-obscure fund that offers investors something that no other fund does than to cover a larger but more pedestrian offering that duplicates investment options already available to investors. Each of these funds is written up in a single-page report that combines data, written analysis, and special tools such as our star ratings and style boxes that we use to create a context for evaluating funds. The star rating is a natural place to start. One of the key things that I'd like to focus on is that the star rating is intended to be an introduction, not a conclusion. With more than 4,000 mutual funds out there, it's simply no longer possible for investors to look at each one individually. You've got to screen down the number of funds to a more manageable size. Our star ratings are intended as a first stage screen, and they're valuable when used as such. Other screens that look only for the stock fund with the highest returns or the bond fund with the highest yield are almost certain to land you in the highest risk funds. There are three ways we think that our star rating is superior to these kinds of elemental screens. One is that our star ratings incorporate risk. The second is that they take a long-term focus. The minimum period for which we'll rate a fund is 3 years. The third advantage of our star ratings is that they include all sales charges and all costs that you would pay if you held the fund over those time periods being rated, 3, 5, and 10 years. The star rating is purely objective. It's not our analysts sitting around a table saying, gee, I really think this manager is a little smarter than another manager. Nor do we put our expectations of what might happen in the market into our star ratings. The rating is a measure of historical, risk-adjusted performance, and it is not intended to be a predictor of future gains. The composition of the star rating is quite straightforward. Half of the rating is based on historical, load-adjusted return that the fund has produced. The other half is based on the historical risk of the fund. The components of the star rating, Morningstar Return and Morningstar Risk, can be seen in the Performance Risk section of the page. Using the Vanguard Index 500 page as an example, you'll see that Morningstar Return for the 3-year period is 1.14. The average for all equity funds, a group that includes the Vanguard Index, is 1.00. This fund's returns were 14% higher than that of the average equity fund over a 3-year period. The risk numbers are scored similarly. For the 3-year period under Morningstar Risk, you'll see that the number 0.73. This means that the fund's risk has been 27% less than that of the average stock fund. For an explanation of how we arrive at these risk and return figures, you can check your user's guide. In the example that we're using, 1.00 equals the equity average for both risk numbers and for return numbers. By comparing Vanguard Index 500 to the average for all equity funds, we're trying to avoid the current mania in the mutual fund industry to be number one in your category. We didn't want a fund's rating to hinge on whether it happened to fall into the small company category rather than the aggressive growth category, or the equity income section rather than the growth and income one. There's so many mutual funds out there claiming to be number one these days, and the irony is that the easiest way to be number one in your category is often simply to be miscategorized. To avoid this problem, we decided to rate funds in much broader pools. We rate all equity funds together, so our ratings won't hinge on how this fund is specifically categorized. For the same reason, we rate all taxable bond funds together and all municipal bond funds together. We've also created a fourth category, hybrid funds, that includes funds such as balance funds, asset allocation funds, and convertible bond funds. Those types of mutual funds that combine both stock and bond characteristics. To ensure that the data are easy to interpret, the Morningstar risk and return benchmark averages for each fund category, stock, taxable bond, municipal bond, and hybrid, are always set at 1.00. Now, what drives the overall star rating of the fund is the relationship between the return and the risk. Obviously, a good combination for a core holding is above average returns and below average risk. In this case, the fund's profile has been quite attractive, above average, a nice combination of above average returns and below average risks. One question that comes up regarding star ratings concerns what causes a fund to add or lose a star in its overall rating. Why does a 3-star fund sometimes slip to 2 stars, or a 4-star fund climb to 5? Ratings are assigned along a bell-shaped distribution curve, with the top 10% earning 5 stars. The next 22.5% of funds are assigned 4 stars. The middle 35% are 3 stars, another 22.5 are 2 stars, and the last 10% are rated 1 star. Over time, a good fund may remain constant and yet get bumped out of the top 10%, the 5-star range, by other stronger funds. Ratings are updated monthly, and because the ratings reflect trailing 3, 5, and 10-year periods, funds may lose stars when a particularly good return in its history drops out of consideration. Conversely, when a sharp downturn is no longer included in the calculation, star ratings can jump. This was especially true in the fall of 1992, when the October 1987 crash fell out of the trailing 5-year period. Here's another way of thinking about star ratings. To use them in assembling a portfolio, it's helpful to think of them as being somewhat akin to batting averages for baseball players. 4- and 5-star funds are similar to 300 hitters on a baseball team. These are the players who are consistently getting on base, moving runners along, scoring runs, and making sure that you don't get shut out of games. In theory, you're going to have a better baseball team if you have a lot of 300 hitters in the lineup. Now, like assembling a baseball team, assembling a portfolio of funds is more than simply looking at batting averages or historical risk-return profiles. In baseball, you'll have a better team overall if, after assembling the core of your lineup, you bring in a home run hitter, a great base stealer, or a defensive specialist. The same is true for your mutual fund portfolio. Once the core is established, it's worth looking for funds with more of a specialty, funds that may not have a very high star rating. Gold funds, for example, are almost certain to get low star ratings because gold is a very volatile investment whose returns haven't always justified the risks involved. But once you have a few solid funds in your portfolio, you may look into adding a gold fund, or an emerging growth fund, or a junk bond fund. These aren't the funds you'd want to base your entire portfolio around, but on the fringes, they can play a very effective role. Because the star rating shows a relationship between return and risk, there are a number of ways that you could have, say, a 3-star or neutral or average rating. That could be derived from either a combination of high returns and high risk, average returns and average risk, or low returns and low risk. It's important to know the difference between a low return, low risk fund and a high return, high risk fund. These two funds may sport the same rating, yet you'd use them very differently in a portfolio. You can see that the star rating alone does not tell you some important information, which is why we give you the breakdown on these return and risk characteristics individually. The second step of reading the page intelligently is to move beyond the star ratings to a more thorough examination of risk and return. An important place to start this is to look at the individual returns for the fund relative to different indexes over a variety of time periods. We provide the trailing 3-month, 6-month, and 1-year returns, and then the average compound rates of return for the 3, 5, 10, and 15-year periods. You'll note that these are average compound rates of returns. One of the reasons we do this is that it gets very difficult to look at longer-term time periods and know what a good return would be. Is a 217% return a good return for 15 years? It sounds good, but that's actually been the money market rate of return. If you look at the 10 or 15-year periods for, say, the Vanguard Index 500, you'll see a 10-year average of 14.05% per year. I know that averaging 14% per year is a very healthy rate of return, and the one that would be very good for my fund. If the number were simply 270% or 345%, I may not immediately be sure whether that's a good or a bad return. And how does 345% for 10 years compare with 412% for 12 years? You need to look beyond simply a 10-year average or a 15-year average because there's a lot of important information that can be covered up by a long-term average return. When anyone quotes you a 10-year number, there's an underlying assumption that you stayed in the investment for the full 10 years, that you didn't panic somewhere along the line, say in the crash of '87 or the third quarter of 1990, and abandon your investment strategy. It's important to break out the returns annually, and we do that in the history section of our page. For the Vanguard Index Fund, you can see that while it averaged 14% over the trailing 10 years, in no individual year during that 10-year period did it actually have a 14% return. In this case, the highest return was 31% in '85 and in '89. The lowest return was minus 3.33% in calendar 1990. It gives you an idea of the range of returns the fund has had over an extended period of time, and it begins to create real-world scenarios for you to ask, how would I have reacted if I had been in the fund during those years? What is the worst calendar year loss the fund has had, and how well could I tolerate that? We take this scenario to another step in the total returns section of the page. We break the returns out quarter by quarter, and we go back to include the fourth quarter of 1987, when the stock market crashed. You can see exactly how hard your fund got hit during that time period. This fund, the Vanguard Index 500, which mimics the S&P 500, naturally took a sharp blow, losing 22.71% in the fourth quarter alone. In another down market, the third quarter of 1990, the fund lost 13.78%. I think it's important to know these numbers if you're going to hold this fund, to know how the fund behaved during markets that were unfavorable. The index fund will suffer much bigger losses than a more conservative fund, one that holds cash, bonds, and less volatile stocks. On the other hand, there are a number of funds that are more aggressive than this fund that had losses that were significantly greater. Wherever you are investing, you need to have an idea of the downside and ask yourself, could I tolerate that loss? Now, you might say that it's a bit extreme to assume that you get into a mutual fund at the absolute peak, but you've got to keep in mind that that may be precisely when the fund looks its most attractive to you, when it's just had a big run-up and is poised for a fall. Mutual fund companies spend millions and millions of dollars a year advertising when things go right for them, highlighting their good performance. But you also have to know what the bad performance might look like. Another way to look at performance on a year-by-year basis is with our performance quartile graph. This feature rates the fund relative to other funds that share its objective, in this case, growth and income funds. The graph depicts, year by year, whether the fund was in the top 25% of its category, between the 25th and 50th percentile, between the 50th and 75th, or in the bottom 25%. It's significant to note that this fund only once finished in the top 25%. It's not a fund that's going to be way at the top during many years, as you would expect, given the fund's index characteristics. But it's also very significant that over the 12 years depicted here, not once has this fund finished in the bottom 25% of its category. One of the reasons this fund has a good star rating is because it has avoided disaster. When the market was down sharply, such as the fourth quarter of 1987, this fund got hurt, but it has also tracked the market's recovery since then. By getting a feel for when a fund is in or out of favor, you begin to assess the risk element of the fund. This is something that we also did when looking at the total returns for individual quarters or individual calendar years, trying to get an idea of the downside. Now, there are two ways to look at risk that I think are important. One is simply to look at the dollars that you might lose over a given period of time. The other is to look and say, if I invested at or near a peak, what would the time period be before I recoup my losses? That's where the line graph that we provide on the page can be very instructive. One of the things that I find helpful to do is to go to the peak time periods of the fund. Here it's just prior to the crash of 1987. Now draw a line horizontally, straight across the page, and then see how long it would have been until you got whole on your investment. In this case, you'll see it would have been about 18 months. Today, you'd be significantly above where you were in that time period, but you would have had close to a year and a half in which you would have had to endure a loss on your investment. Ask yourself, is that a time period that I could live with, supporting a loss on my investment portfolio? If the answer is no, move on to another page. Look for another fund. There are funds that are very good at avoiding losses. Typically, they won't offer as much in return, but if it's a more appropriate fund for you, it's a fund you should be in instead of the one that requires more risk tolerance than you have. We've talked a lot about risk here. I happen to think that the most useful ways to think about risk are in dollar amounts and in time periods, because these are areas that people can relate to most easily. But there are a number of academic ways that you can look at risk as well, and we provide those on the page too. One of those is beta, which is a measure of how volatile a fund is relative to a given index. For stock funds, that index is the S&P 500. In the case of the Vanguard Index 500 page, where the fund is designed to mimic the S&P 500 and has done so successfully, the beta is 1. In the case of a more aggressive fund, the beta might be 1.20, which would suggest that the fund has had 20% more risk than the S&P 500. Similarly, a beta that's lower than 1 would suggest that the fund is more conservative than the S&P 500. You'll find a more detailed explanation of beta, as well as alpha, R-squared, and standard deviation in your user's guide. We talk a lot about risk at Morningstar because it's one of the more important elements of forging an investment program. Obviously, it's important for the individual investor because it determines whether or not you can stick with a program, and that's extremely essential. But it's also important because risk is something that a portfolio manager has direct control over. A portfolio manager can't decide to have a 5% return over the next 2 months. But a portfolio manager can decide to take a significant amount of risk or to tone down the risk in a portfolio over any given time period. One of the ways I find helpful in thinking of this is to use a poker analogy. If you're going back and looking at historical returns for a fund, it's somewhat akin to looking back over a string of poker games. Now, knowing a fund's total return is somewhat like knowing who won what at different poker parties. The problem is, just knowing who has won the most historically doesn't tell you who's going to win next week. The way risk plays in this poker game is not to tell us who is going to win or lose, but to tell us which tables the different players sit at. Is this portfolio manager a high-stakes gambler, or is this manager a penny-ante bettor? That's the kind of thing that doesn't change overnight. That's why we've gotten much more involved in dissecting the portfolio, not just presenting the historical return and risk for each fund. What we do is we enter every security that each mutual fund owns into our computer database, all of the stocks and all of the bonds, so that we can calculate statistics based on the securities that the funds are actually invested in today. This is essential at arriving at conclusions about what you might expect from the fund tomorrow. Here's a look at the top 25 stocks in the portfolio of the Hartwell Emerging Growth Fund. Manager John Hartwell's portfolios have always been very concentrated and quite aggressive. If you look at his portfolios today, you'll seldom see more than 50 names, and the top holdings may easily have 5% of assets each. In contrast, you can look at a fund like Pennsylvania Mutual, which often has 500 or 600 holdings in its portfolio. Their top 10 positions may not even make up as much in assets as John Hartwell might have in his top stock alone. You're not going to wake up tomorrow and find John Hartwell mimicking the S&P 500. By the same token, you're not going to wake up tomorrow and find Chuck Royce and Tom Ebright, the managers of Pennsylvania Mutual, out there with 7% of their assets in one biotechnology company. That's something that's important. That's something that you can take from the past and project reliably into the future. By tracking the risk that managers are taking, both historically and currently in their portfolios, we can bridge the gap between past performance and future expectations. Scrutinizing the portfolio also allows us, in many cases, to see beyond some of a fund's marketing claims. There are a number of funds out there whose name and market position might suggest one type of behavior, but the actual portfolio tells a different story. One of the things that we can calculate, for example, is the type of stock that managers are investing in. How big are these companies? Are they the giant blue chips or are they the small cap, higher risk companies? That's an important distinction to make. There are a number of funds out there that have a reputation or a name that suggests they invest in small companies. But when some people say small company, they mean companies that are extremely small, under $100 million in assets. Other funds with small company in their name have an average company size that is 10 or 15 times that, even approaching $2 billion. Yet both of these funds may be included under the small company banner and be ranked against each other. If you're thinking that these two funds are similar, though, you could be in for some surprises. So one of the key things we're looking for are elements that you can take from a fund's history and use to project with some reliability into the future. This gets to the heart and soul of what we're trying to do at Morningstar, and what is, I think, the most interesting work we do. to show in detail what the mutual fund is doing today. If the people and practices driving the fund now are not in keeping with the fund's history, then you can't take any of the historical analysis and project it forward with any degree of reliability. That's why it's so important to be able to get a true and accurate picture of what the fund is doing today. One of the things we've done to help investors is the style box. What we illustrate here is a combination of two things, one of which is the size of the companies. The fund may be holding large companies, the big blue chip names with median market caps greater than $5 billion. Perhaps they're investing in more medium-sized companies that are starting to get more attention, those that have gotten past the emerging growth part of their business cycle but have yet to become the dominant large cap players. Or you may be looking at small companies, those with median market caps of less than $1 billion. These companies could be tomorrow's leaders. That's one element of our style box, the size of the companies, large, medium, or small. The other element is the style used in picking these companies. Maybe it's a value-oriented philosophy, which would suggest conservatism. Or perhaps the manager is willing to pay up in price to get companies that are growing at a rate faster than the market. Or these could be companies like those of the S&P 500 index, which combines both growth and value characteristics, in which case we would assign the fund to the blend box. The 9-box grid in the middle of the page outlines these different style characteristics and sizes of companies. The styles, value, blend, and growth, and the sizes, large, medium, and small, tell you what territory of the stock universe a fund has carved out for itself. And it's very interesting to note that there are very distinct risk characteristics associated with these 9 different boxes. In general, the risk gets greater in mutual funds as they move from large cap companies to small cap ones. Similarly, the risk is higher in growth stocks as opposed to value-oriented strategies, which tend to be more conservative. Of the 9 boxes in the grid, the lowest risk style box is large cap value. The highest is small company growth. Aside from indicating general levels of risk, the style box is also helpful in building a diverse portfolio of funds. Many times, people will assemble a portfolio from, say, last year's leaders list. They'll pick 5 or 6 different funds managed by different managers in different cities and from different fund companies. Yet what often happens, because these mutual funds performed well during the same market environment, is that they did so because they were invested in the same types of stocks. So what at first appears to be a diversified portfolio, in many cases turns out simply to be different shadings of the same investment philosophy. A final side note about style boxes. Because we're using Vanguard Index 500 as our example, I've only discussed style boxes for stock funds. In covering bond funds, we calculate style boxes to pinpoint credit quality and average maturity for the bonds in the fund's portfolio. Now we can turn to our stock exchange index allocation section, where we can tell you exactly where a fund is investing its monies. Are they in the big companies of the Dow 30, or are they in the major companies of the S&P 500? Are they in the smaller indexes, such as the S&P Mid-Cap 400? Are they in the major exchange-listed stocks trading on the New York Stock Exchange? In the case of the Vanguard Index 500 fund, that's very much the case, with almost 93% of its portfolio listed on the New York Stock Exchange. Another key element to look at here is what percentage of the fund's assets are invested in foreign securities. Is this manager staying close to home with his or her investments, or is this a manager who is investigating opportunities outside the U.S.? Increasingly, mutual fund managers are broadening the boundaries within which they invest, and many funds that are considered as domestic or U.S. funds are holding larger and larger positions in foreign stocks. In fact, there are a number of funds out there that don't have foreign or global in their name that actually have 20, 30, or even 40% of their assets invested abroad. At the same time, there are funds that do have global in their name that have less than 20% of their assets invested outside the U.S. So it's very important to get a feel for what's really happening in the portfolio, and not just to rely on the name of the fund if you're going to use it wisely in your investment program. Another element to look at is portfolio composition. See if the fund is invested in stocks, if it is holding cash, what percentage it has in bonds. If you've had a fund that's been very low risk historically, but now suddenly you find it 100% invested in stocks, that may mean the fund is taking a greater risk now than it has in the past. Next to portfolio composition is a box labeled tax analysis, which gives you a look at the after-tax total returns. This is a new but very important addition to our page. In an era of lower absolute returns from funds, it will behoove investors to be more tax smart, to know the hidden liabilities they assume when they purchase a fund. We show how tax efficient a fund has been historically, and also how much of a burden future taxes may be. Moving across the bottom of the page, we come to the operations section. Look here for the portfolio manager. Morningstar was one of the first organizations to systematically list the portfolio managers of each mutual fund. In many cases, we list not only the year, but also the month the manager started. It's very instructive to know whether a portfolio manager started in January of 1987, prior to the crash, or in November of 87, following it. You need to know who to attribute the 1987 returns to. In the case of Vanguard Index Fund, you'll see that the manager, George Sauter, has been there since October 1987. All of the sales fee information is disclosed here. Expense projections, annual brokerage costs. Just how expensive is it for a fund to trade these stocks? There's information on purchase requirements and sales charges too. Also, what management fees does the fund charge? Are there 12b-1 fees? What are the overall fees that may affect your investment performance? All of those are included here on the page, and all of them can be very important for asking the question, are the people and practices that built this record still in place? To get a feel for how the fees actually affect your performance, you might look at the fees that are listed here. Also look at two other elements on the page. One of these is load-adjusted returns. We provide these for the trailing 1, 5, and 10-year periods. Now for a pure no-load fund, these returns would be the same as the returns given in the performance risk section. But if the fund has a front-end load or deferred sales charges, these numbers will be lower by the amount of that sales charge. You'll see the actual impact these sales charges had on your performance over the applicable time period. The other thing to look at is the expense ratio. This is in the history section of the page. Here we go back 12 calendar years to show you the expenses of the fund. What amount has been taken out year after year, and how much of an impact has this had on performance? It's important here to look for trends. Are the expenses heading up? Have they moved sharply in one direction, up or down? If you have a fund that has very high expenses relative to its peers, you're going to get a lower yield for that fund because the expenses are paid out of the income flow. So the higher your expenses, the lower your yield. There are a lot of numbers and statistics on the Morningstar page, and at times trying to take all of these in for every fund can be a little daunting. That's why we provide the analysis section. Our analysts are given two main tasks when analyzing a fund. One is to call up and interview the portfolio manager who runs the fund to collect additional information that may be of use to you, late-breaking stories or interpretations on fund performance. There are a number of different ways a fund can get a 10% return over a 6-month time period. How it happens to get that return may be much more important than what the return was. The second task that the analyst has is to point your eye around the page, to identify the key statistics for any individual fund. There is no one simple formula for analyzing a fund. There's a different statistic in every fund's history that may be a key element for anticipating future performance. For some funds it might be high cost or rising cost. For another fund, it may be especially good performance during certain types of markets, such as the value-driven years of 1989 and 1992. Our analysts can help interpret that, highlighting points that may be of particular use and help guide your eye to the most important elements of each fund's review. We list the analyst's name on each fund. We do that because we believe it's important that there be accountability. If you have questions about the analysis, if something doesn't ring true, feel free to call the analyst or call our product support staff. We like to back up the work that we do and make certain that you understand what we're saying, as well as our rationale for saying it. Keep in mind that at Morningstar we cover more than mutual funds. We publish information on closed-end funds, variable annuities, and international equities. We also offer computer software for tracking and analyzing both mutual funds and variable annuities. You can contact our product support staff for more information on any of our other products. I hope this brief look at the Morningstar page has been helpful. There's certainly much more, and I strongly urge you to read through your user's guide for an in-depth look at all of the features of our mutual fund coverage. Also keep in mind that our product support staff is ready to answer any questions that you might have. They are available Monday through Saturday at 800-876-5005, and they can be enormously helpful. Thank you for watching.